Now we move on to our second issue, which is a very meaty issue, and we'll have to rifle through it, but we'll come back to it at a later time. Great dangers to the global economy. Now, let's start off with the global headline inflation rate. Lots of projections. Some of them are 4.4% to 5.2% for developing economies, around 3% for developed economies. Note that America's annual inflation rate, despite the fact that America is energy independent largely, yes, it does import some stuff, as we point out in our many briefings, but it's not Germany, it's not Japan. It has a lot of oil, it has a lot of gas. And America's inflation rate, despite all of that, surged to 3.8% in April. That's the highest in 3 years. Fuel oil prices were up by about 5.8% compared with March. At the beginning of 2026, annual inflation stood at 2.4%. Very simply, what's happening, you can see the headlines on all sorts of newspapers. Iran shock squeezing real wages in world's rich countries. That was yesterday's FT's top headline. In a nutshell, wages are down, inflation is eating away the incomes of workers. And whilst this is happening, there's been a very dramatic story when it comes to bonds. And that is the aggressive upward repricing of long-term government bonds. The yield on 30-year US Treasury bonds has pushed above 5%, reaching its highest point since 2007. Remember 2007, 2008, we had the global financial crisis. So we are back to 5% plus territory. Equivalent sovereign yields in Germany, Japan, and the UK have climbed into a 3.5% to 6% range. So why is all of this happening? Well, 3 reasons. Number one, the trigger of the US-Israel-Iran war. That has caused a supply shock. The Hormuz crisis has closed the Strait of Hormuz. It's worse than the Suez crisis in 1956, worse globally. And it has led to global inflation. And this inflation is causing tremendous strain. And this has come at a time when, number 2, there are structural issues. What are those structural issues? For years, and this is something managing partner Sanjay Acharya has pointed out, he's gone through various budgets, he's pointed out that cutting spending is politically really difficult. So politicians keep kicking the can down the road. You have high debt and continued deficits. And we are starting to see the first signs of a sovereign debt crisis. So that is the second reason why bonds are suffering or bond prices are falling. The third is political. There has been interference with the federal, or rather, let's use active voice. US President Donald Trump has interfered with the Federal Reserve. We have a new chair of the Federal Reserve who's expected to raise interest rates. Nevertheless, there's a widespread perception that central bank autonomy in the US, the country that underpins the global economy, the country which has the reserve currency of the world, the dollar, that in itself is in question. And all these factors together have pushed up interest rates on long-term bond yields. And why does this matter? This matters because this means that countries have to pay more on interest. So that means there's less for guns and butter. And long bonds are breaking, not just in one country. They are breaking simultaneously in many countries. Let's pick four countries, 4 different political systems, 4 different central banks. And all of them, US, UK, Japan, and France, simultaneously saw a challenge. Their prices were dropping, the interest rates were rising. And as one analyst said, the developed world has too much debt, too little fiscal discipline, and no political appetite for fixing either. Over to you, Glenn.
I agree with everything you said. And let's look at what the U.S. is doing to itself in large part, and why this will have both long-term and is having, as we're seeing in inflation, even short-term consequences. So the U.S. is eroding the foundations, the structure of its that have underlay the strength of the strongest economy in the world, of the United States economy, and of its currency, which is the world's de facto currency, the reserve currency. Why? How? We can't blame Donald Trump only for the structural deficit, the federal deficit, but he has made it dramatically worse, literally added more to the deficit of the United States in his term of office than all other presidents in American history combined. And that's not just using constant dollars. That's in absolute terms, which is really should be
quick fact.
At the same time, he's done that, and one of the reasons.
Quick fact: U.S. debt crossed 39 trillion, and the last trillion rose at record rate. So what has happened is spending has continued at even higher levels. The Iran war is expensive. And tax cuts have meant that government income has gone down. So deficit keeps going up. And how do you finance the deficit? You have to take more debt. So debt is growing at record pace. Over to you, Glenn.
Well, you took the words right out of my mouth. The next point I was going to make was that the tax reductions are like eating some sugar, short-term pleasure with long-term risk of heart attack. The trade restrictions are distorting the economy and making it less efficient, not just the United States, but global economy. Research and development funding will not have any immediate effects on growth rate, therefore on tax revenues, therefore on deficits. But American R&D expenditures by the federal government have been halved, I think literally, by Donald Trump. And this truly is eating your seed corn, and you will not be able to plant any in future years. I mean, that's almost a literally opposite metaphor. And something not noted sufficiently at all, for all of the talk about the immigration issue in the United States, the hostility to immigration and its shutting down immigration and the immigrant workers in the United States economy is having not just social effects, which are a legitimate issue to debate, but also profound economic effects. And they are, the recent studies have shown that immigrants in the past, I think it's 15 years, I forget the exact time frame, but in recent years, not fully even decades, have contributed a net 15 trillion, that's with a T for Thomas, $15 trillion to the U.S. economy. That is now lost, as are the workers who have for my entire lifetime harvested the crops that give Americans low-cost food. Thus, food costs have risen higher than the base rate of inflation. And the primary pressures or on an American consumer, and most people everywhere, are food costs, housing costs, and transportation costs. So in addition to having migrant workers cause their lack, bring about a rise in food costs, the crisis in the Middle East and the Straits of Hormuz have dramatically increased the cost of fertilizers, which accounts for apparently 1/3 of the cost of agricultural production. And so that increases food costs. Interest rates have gone up, and mortgage rates are unusually high relative to other interest rates. That's another structure and a structural strain on the American consumer. And then you have transportation costs because the price of gasoline, although it is dramatically low in world terms in the United States, is nonetheless twice what it was, roughly speaking, only 2 years ago. In consequence, Americans have been deficit spending. They've been going into debt to cover the roof on their head, the car they have to drive to work, and the food they have to eat to survive, which make up the large portion of the domestic expenses for a person. And if debt increases, interest rates will increase and investment will decline. And so this is a structural pressure as well as becoming a political problem for the American political system. All of this almost all of this are things that the United States has done to itself.
All right. So even as the real economy is clearly facing pressures, the stock market bubble continues. And what do we see there? We see, number one, extreme market concentration. The top 5 mega cap technology companies now command roughly 30% of the entire S&P 500 index. The Magnificent Seven, Glenn pointed out just before we began this, command 35%. This is the highest level of market concentration in half a century. NVIDIA alone has crossed $5 trillion in valuation. So their GDP is bigger than the GDP of many sovereign nations. There's been a deluge, a capex deluge. Major cloud hyperscalers, Microsoft, Alphabet, Amazon, and Meta, they are projected to spend a collective $660 billion to $700 billion on AI data centers and infrastructure in 2026 alone. From 2026 to 2029, AI infrastructure spending is modeled to exceed $1.1 trillion. Now, let's look at the Shiller price earnings signal. This is a very popular ratio, the Shiller price to earnings ratio. It adjusts for 10 years of inflation. This has pushed over 40 for the first time since the dot-com crash of 2000. I repeat, this has pushed over 40 for the first time since the dot-com crash of 2000. Historically, whenever this has happened, there has been a major structural market correction. Our friends who are older expect 15 to 20% correction, some of the bears. The ratio right now, the Shiller PE ratio is 42:1. This is at a time when generative AI applications are tracking just 12 billion to 15 billion in direct consumer enterprise software revenue. Now, there are counter arguments. We must mention them. Number one, many people say that today's market leaders are cash flow powerhouses. So S&P operating margins are sitting at historic highs of nearly 16%. The tech giants funding this boom, you name it, take your pick, whether it is Google or whether it is Microsoft, they're all printing money. They have high margins in their core businesses, so they're using these massive cash reserves, and they are not relying on speculative junk debt. Some also point out that the economy is facing a K-shaped corporate shift. What does that mean? Well, standard legacy businesses could save cost, massive structural cost, by shifting automatic workflows to AI. This is happening even in hospitals. So on the whole, there are arguments for this time it is different, which I, of course, don't buy. And frankly, nor do many other people. Greg Abel, the chief executive of Berkshire Hathaway, is sitting on a cash pile of $400 billion amassed under his predecessor, the legendary Warren Buffett. Abel is in no rush to make acquisitions because he's not anxious to deploy capital into subpar opportunities. By the way, those were his words. Now, the Wall Street Journal had this headline yesterday: risk premium for holding stocks over bonds vanishes. What does that really mean? Glenn quizzed me on it. So very quickly, the equity risk premium is the extra return an investor expects to receive for holding a risky asset, like a stock. So if you hold, say, US Treasury bonds, that's completely safe, or used to be seen as completely safe, risk-free. But now, and therefore, if you held stock, the expected return on stocks was to be more than the risk-free rate. So this now, basically, there's a very little difference between stocks and bonds when it comes to the rate of return. What does this mean? There's a complete disconnect between the stock and bond market. The stock markets are going up, up and away, whilst the bond markets are melting down. And some say this is a sign of a bubble. Some also say that financial prices on screens, and this is something we have tracked. Our managing partner, Sanjay Acharya, has tracked, and our other partner, Manu Sharma, has tracked it very closely. Financial prices are increasingly disconnected from real world prices. So if you want delivery of a barrel of oil in places like Asia, you pay significantly more than what shows up on the screen. So there's a disconnect between the real world and the financial world. There is a disconnect between Wall Street and Main Street, and institutions such as the European Central Bank now are warning against the AI-fueled investment boom. And they're also warning about this boom being financed by private credit. They say this could hurt not just the US, but the euro area's financial system as well. Insurers and pension funds could face particular risk. There are opacity issues. There are liquidity mismatches. We've talked about this earlier. We have covered this earlier. But in a nutshell, what is happening is there's a lot of stress and there's a lot of strain. And in poorer countries now, you go to India, you go to Indonesia, you go to Kenya, there are already talks or leaders are talking of conserving fuel, working online, or centralizing export of commodities. In the case of Indonesia, there are protests in Kenya. So the poor countries are already facing the strain in a much more real and tangible way than richer countries. Over to you, Glenn. Final parting words for this month.
I just note that 67%, I think that's the exact figure, of the U.S. economy is determined by or consists of consumer spending, and that the gains in the stock market, which have made many people wealthy, are restricted to only about 1/3 of Americans own stock, and wealth is concentrated more in American society today than at any time, I think, since the 1890s and possibly in American history. So that that the top 1%, and you could say maybe the top 5 or 10%, are living happy days and can go out and buy a larger boat or yacht, when the vast majority of Americans, middle class America, as we used to call it, are feeling the real pinch from transportation, insurance, mortgage, and food increases that they can only cover, because wages have been roughly stagnant for years, by increasing their personal debt, which is unsustainable. Thus the dissatisfaction and the danger.
On that note, we will see you next month. Those of you who are watching us on YouTube, subscribe to our channel, press the bell icon so that you get notifications. Follow us on Fair Observer, sign up for our newsletter. And until next month, it's bye for now.
Join the conversation at Fair Observer and subscribe to our YouTube channel.